All right, let's get a nice wrap in terms of what is going on in the markets with the TSX down over 300 points, U.S. markets down as well. Joining us is David Rosenberg. He's the chief economist and strategist at Gluskin Sheff Associates. David, great to be able to catch up with you today on an interesting day in the market. I thought we'd be talking more about the BoC, which we'll get to, but I first want to get your take in terms of the equity markets and what's getting priced in and people's expectations.
Well, I think that the bottom line is the worst enemy for the stock market is a word that starts with U, and it's uncertainty. So you know what, when we were shooting up to new highs last year in the S&P 500, nobody seemed to be too bothered by it. But that's because you know, we had Janet Yellen, who we knew, we're very fond of. She was a low interest rate Fed chairperson. We were looking forward to the tax cuts, and of course the deregulation craze was in. So actually, you know, you want to talk about what's happening today, but today is just a microcosm of what's happening all year long. It's just been this massive roller coaster, heightened volatility, because we don't have yesterday's certainty. We have tomorrow's uncertainty related to tariffs, trade wars, a new and untested Federal Reserve that seems to be quite a bit hawkish. Of course, we saw some of that tone out of the Bank of Canada today. And so there's quite a bit of that related to tariffs and interest rates. What's happening geopolitically? This time last year, were we talking about a budget mess in Italy? No, we weren't. We're talking about accelerating tensions to this level with China. No, we weren't. We're talking about something that's totally new this week, which is Saudi Arabia, and then the implications this is having on oil prices if the Saudis have to ramp up production because they're going to lose revenues from some of the businesses related to this latest file that we've all been talking about the past couple of days. So it just all the uncertainty is commingling right now, and there's a lot of profits that were made this entire 9-year bull market, and the reality is that quite a lot of investors right now are deciding to book those profits.
Mm-hmm. David, when we take a look at, and as you say, what we're seeing today is really the microcosm of what's been going on. There are some equity strategists who would say some of those events, like Italy's budget or like Saudi Arabia, actually don't impact the fundamentals of good corporate earnings in the United States. I think that they do a little bit, and I think that you're seeing that in the company's outlook, specifically in the industrial companies. But how do you dovetail that comment from some strategists with how you look at investing?
Well, look, you're talking about two different people. You're talking about analysts on the one hand who only get paid to cover companies' fundamentals. And then you have strategists whose job is to forecast the stock market. And you can't just forecast the stock market based on earnings fundamentals alone, because the stock price index is a function of two numbers, which is the earnings, and then there's the multiple. And the multiple is really the heartbeat of confidence. And that's what I was talking about before, is that it's not about earnings. It's about the multiple that investors at the margin are now willing to slap on those earnings in a heightened, uncertain global macro and policy and geopolitical environment. So that multiple is compressing, and the multiple is inversely correlated with the level of uncertainty. So it's not about the corporate fundamentals. My Lord, I started in this business on October 19th, 1987, when real GDP growth was 7% in the United States. Not 3 or 4, it was 7.
Yeah.
And earnings were running 50%, and we had the mother of all corrections. If I'm not mistaken, my first day in the business, the market was down 23%. Why? Because liquidity was drying up, the Fed was raising rates, Reagan was not slapping China with tariffs, but Japan. You know, as Mark Twain said, you know, it doesn't have to repeat, it just has to rhyme. But it's not always about the fundamentals. It's also about liquidity, it's about sentiment, it's about market positioning, and it's about the general level of uncertainty related to whether it's the geopolitical backdrop or the domestic policy backdrop. You know, one of the things that's happened this year that's caused this roller coaster ride that maybe equity analysts don't pay attention to as they are consumed with company fundamentals is this time last year, the yield on the 2-year Treasury note was sitting at 1.3%. Today, it's almost at 3%. It's at a coronary. And so interest rates, you know, ultimately, you know, everybody looks at today's earnings backdrop, or we're all focused on the third quarter earnings backdrop. But the reality is that the stock market is a long duration animal. Actually, the duration on the S&P 500 is 50 years, not 4 quarters or
Right.
1 quarter. And you have to basically discount that future earning stream into the present with an interest rate. And those interest rates are going up. And I think that's been one of the, if you're going to ask me, what is the one thing I could point to, everything else aside, that's undermined the stock market this year has been the run up in interest rates at the front end of the yield curve.
But when you take a look at the 10-year or 5, 7, 10-year, the bond market, isn't the bond market telling us that the Fed and or the BOC won't be able to raise rates that many times, that the outlook, to your point about what growth used to look like in 1987 at 7%, that the current growth isn't going to be that great?
Well, I think certainly the flattening of the yield curve is telling you that story. But, you know, the reality is this. You know, we have, say, the 10-year U.S. Treasury note yield at 3.1, just the other day with 3.2%. We were at 1.35% just after Brexit, July of 2016. When you're taking a look at the Treasury market in ratio terms, not basis point terms, because when you're at these microscopic level of yields, you have to take a look at the situation in ratio terms. And we've had basically more than a doubling in the 10-year Treasury note yield just in the past couple of years.
Yeah.
This goes down as one of the most pernicious cyclical bear markets in treasuries that we've had on our hands. So yeah, I think that there's some truth to that. Look, did I share the Bank of Canada's ebullience today in their statement? I was actually had to pick myself up off the floor when I read the first sentence that the global economic outlook is solid. I'm there thinking, wow, the OECD leading indicator, which is a leading indicator, that's the outlook. It's down 9 months in a row to its lowest level since December 2016, and they're telling us the outlook is solid. My eyes were rolling on that
well,
one.
and I want to talk about that a little bit. I mean, I want to get your take too in terms of what our viewers, our investors need to do with their portfolios. But I do want to talk about the BOC, because when their outlook is 2.1% growth this year and next year, and then down to 1.9%, and yet they're hawkish as it relates to raising rates, and we're going to continue to see raising rates because the economy is strong, and our finance minister, Bill Morneau, was here earlier, not on my program, on an earlier program, and he's confident about the business outlook, and obviously confident enough to be able to put carbon tax on various provinces. That's a whole nother conversation. But is he wrong? It sounds like you say he's wrong.
Well, look, if I was a politician, the economy would be strong every moment of every hour of every day. So the finance minister says the economy is strong. Well, he's a politician, so of course that's what he's going to say. The year-over-year growth in real GDP in Canada is 1.9%. So I guess if that's robust, we have to come up with a new definition. I guess 2 is the new 4.
Right.
You know, I could see why the bank raised rates today. That's fine. It was baked in the cake. But to be so open-ended and to be, in my opinion, so strident about I would not have decided to take the word gradual out at this meeting. I would not have left every meeting going forward as a live meeting.
What does that mean, David? When we take the word gradual out and every meeting's live, what does that really mean to our viewers at home? What do they need to be mindful of and brace for, perhaps?
Well, you see, to the Bank of Canada, it's like really nothing. We just want to be more flexible. But to the markets, what it means is that the bank is now, instead of raising rates, a couple of times a year, now they're going to move rates, every meeting. That's really how you would take it literally. They left themselves enough flexibility. I was really stunned at the extent to which they changed the language, getting rid of gradual, letting everybody know that we have to get to neutral. Neutral to the bank, the midpoint is 3%. So what are you telling us? That by this time next year, you're going to move rates up another 125 basis points? We are so debt laden.
Yeah.
The household sector, I estimate that over $1 trillion of household debt is going to roll over, get refinanced the next year at an average rate that's going to be more than 100 basis points higher than they are today. That's going to be a really big pinch on the 60% plus of GDP called the consumer. So, personally, I don't have that job in Ottawa. I wouldn't have worded it the way that it was worded. I wouldn't have sounded so hawkish. There's just too much uncertainty. Now, there was a lot of caveats in this statement.
Yeah.
But the statement is written up carefully enough so that the markets will catch the Bank of Canada's drift. And there's nobody you'll talk to today that will not tell you that that was a very hawkish statement. I would have left it at neutral. That's what I would have done.
David, why would they be so hawkish? What's the point in that?
Well, look, I'm not there behind closed doors. I think that they would say publicly is that, well, we have to, we are an inflation-driven central bank. For us to actually meet our 2% inflation objective, this is what we're going to have to do. But, I'm looking at the inflation numbers, and there's only about 24 of them. But, the core inflation, the way I used to look at it, ex-food and energy and indirect taxes, it's running at 1.5%. I'm taking a look at, say, the 10-year break-even levels in our real return bond market. The market-based inflation expectation for the next 10 years is 1.7%. Nothing I'm looking at is really that close to 2%. For such a long time, Stephen Poloz was talking about that the bank was discovering new excess capacity, undiscovered excess capacity in the labor market, so that they could actually be gradualist. I mean, I don't know what's changed.
Yeah.
I can understand in the U.S. Look, in the U.S., the unemployment rate is down to 3.7. Ours is at 5.9. I would say, yeah, 5.9 sounds tight, but if there wasn't slack in the Canadian economy, still some slack, residual slack in the Canadian economy, why is wage growth slowing down? Like in the United States, you could say, well, 3.7 on the unemployment rate, well, that is tight, because guess what? Wage growth is accelerating in the United States, and we haven't even seen the Amazon numbers, 15% wage increase, and the spillover come into the data yet. That's still coming down the pike. Wage growth in Canada has been slowing down every measure precipitously this year, which would leave any economist wondering, how could that be happening if we're really at full capacity in the economy?
That's my question, and one of my questions, of course, is if, as the BOC says, we're close to full capacity, why don't we see the wage growth, to your point, but also why is growth so muted? Why, if we're close to full capacity, what does it mean about us if we can only grow 1.9%? What does that mean?
Well,
what does that mean?
Well, there's a lot of structural impediments in Canada. We don't have nearly the same degree of stimulus on fiscal policy. In fact, with carbon taxes, you'd argue that we could be shifting more to a tighter fiscal stance.
Yep.
We have interprovincial barriers that don't seem to be getting better. We create our own barriers to growth. And let's face it, in the United States, you're sitting there in the Fed, and up until recently, energy producers in the U.S. We're enjoying $70 WTI, but that's not our benchmark. When you look at the blend of Western Select with WTI, our oil price is about $40. So that's been one of the impediments to growth, say, in the energy patch, not to mention all the pipeline bottlenecks, so on and so forth. The Bank Canada mentioned a couple of times, okay, that we have this trade agreement with the United States, but who knows what sort of impetus we're going to get. We're still left with a sunset clause, whether we like it or not. We didn't have it there before. Now it's 16 years, and it's unclear as to which industries that might affect their decision to invest in Canada or not. The one thing that's not been addressed is that the fact that we are no longer tax competitive in the corporate sector with the United States. And so we'll see what happens in the federal budget, but for the here and now, if you're a North American business, you are still being incentivized to book your revenues in the United States and not in Canada. So, this broad expectation that we're going to get a capital spending boom, I hope that happens. By the way, that's supply side disinflationary growth, not inflationary growth. Let's hope that it happens. But you're quite right. I was just struck today in the Bank Canada statement by the degree of hawkishness. Look, we've seen the Bank Canada flip before. Maybe they don't raise rates, but they're putting us on guard for interest rate increases that will come earlier. And I was not thinking at any time that the bank was contemplating getting to 3%, which is the midpoint of neutral, anytime on the radar screen. And now we have to contemplate that. And the impact on debt servicing, when you consider the impact of the interest rates coupled with the stress tests, this newfound stability in the housing market, say outside of Vancouver, well, it ain't going to be so stable for much longer.
What you're essentially saying is something that they might come to realize as well, and therefore we won't actually see as many rate hikes as the statement perhaps today suggested, and essentially that's what the bond market is telling us as well. But David, I want to get from you, for our viewers, you as a strategist versus the fundamental analyst, and it's a really important point. How do you think this plays out? From an equity market perspective, a bond market perspective, U.S., Canada, how should investors be positioned? You're obviously seeing the big money managers, the hedge funds, and the long-only guys taking profits, locking in profits. There's probably people at home wondering if they should be doing the same.
Well, I think that if you haven't been de-risking your portfolio, this year, it's really not too late to start.
Okay.
And look, I've been in this business for over 30 years, and I've learned two things. You don't put all your eggs in one basket, and there's no such thing as a sure thing. So I don't really believe in 0 or 100 at anything. If you're going to be in the equity market, be smart about it. Cull your portfolio. Operate in a late cycle framework. Early in the cycle, you can own a lot of stocks because the opportunities are abundant. Late in the cycle, the opportunities get more restricted. So basically, limit your equity portfolio to your best and your most high conviction ideas, non-cyclical in nature, high earnings visibility, high quality companies, and I think that that's how I'd be operating right now. In a more defensive orientation, I think that I'd want to be stylistic when I talk about late cycle. I want to guard against incipient inflationary pressures. I want to guard against rising interest rates. Generally, financials and energy screen very well, for example. You don't have to be out of the equity market entirely, but you want to screen for inflation. You want to screen for higher short-term interest rates, that's for sure. And you want to make sure that you have a high-quality portfolio. And you also want to make sure you have liquidity on hand in this sort of very volatile environment. This is actually everything happening this year. It's not a surprise to me. Well, we had a first peak in January. We had a failed breakout in September. We had a breakout in price, but not in volume and not in breadth. It looks just like it did in 1989. It looks just like it did in 2000 and 2007. This is classic late cycle topping formation. It doesn't mean everything goes down for the count, but it means that you basically want to have high quality inflation protection. You want to benefit from rising interest rates. Financials usually fit the bill on that score, and I think that they're well priced on both sides of the border. And you want to start thinking about moving out of the growth stocks that have performed so well this cycle and moving increasingly into value stocks. To me, that's an appropriate strategy if you're in the equity market.